Hello and welcome to a brand new episode of Smart Money. Today, as part of our Outstanding Women in Finance series, joining us is Lakshmi Iyer, a woman who has blazed many trails over the years. Lakshmi is currently the President and Chief Executive Officer at Kotak Investment Advisors. She has been with the Kotak Group for over 22 years and was earlier recognized as one of the top 25 most influential women in asset management in Asia by Asian Investor. Today, we speak about her journey. We also try to understand the importance of asset allocation in a year when equities could take a backseat amidst talks of a global recession. Lakshmi, thank you so much for being here with us on the show. I think it's a while since you've been here. The last time we spoke on Zoom because of COVID. But
right.
Thank you for being here.
Thank you, Sonia. Pleasure to be here, and seeing people live is always another high, always.
Absolutely. I spoke a little bit briefly about your journey, but how has it been for you in financial markets? We were talking in the break about how it has become perhaps easier for women to thrive in this industry now, but things have not been the same over the last decade or so. Yeah. What has your journey been like?
Well, one word to define my journey would be like a roller coaster, because there are ups and downs, but there are thrills, and I love roller coasters. Okay, I've pretty much been to every theme park in the world, including SL World closer home when I was in school. But I think the joy of, irrespective of the way you start, whether you start off as a roller coaster upside down, the ending is always happy. So, I've never seen a roller coaster which ends you with yourself inverted. So I think that's the joy of being in the financial market. You're tracking stuff every day, every moment. You're not just tracking India, you're tracking the globe. The adrenaline rush is very, very high, and for a teetotaler like me, I would say that's a big kick.
Okay, that's something we have in common then. But do you think gender matters in today's day and age? I mean, we've called this segment Outstanding Women in Finance, but don't you think we've reached a sort of a gender agnostic industry, or is it still too soon?
I don't think so. I would say it is about what you bring to the table and what kind of skill set you are able to marry in with the role that you are going to do. In this particular case, it is the financial services. Women are lesser in number, no doubt about it, but I still believe that this role is very gender agnostic. So if you love numbers, you're there, and if you don't, you're elsewhere. That's what it matters.
Okay, so it's just like any other industry, perhaps, that thrives. It doesn't really depend on what your gender is. Got that? But what is the best way to approach the markets now? I ask you because, as we started the show, we mentioned how it's really a volatile year expected ahead with the recession, with higher interest rates, with higher inflation. Now, the big question is, what should my asset allocation strategy be for 2023? What is your advice?
Sonia, my view always has been, and I say this to everyone, that asset allocation cannot be a calendar year exercise. That's point number one. It has to be basis your risk allocation, risk appetite, and most importantly, what is the longevity you're letting that money run for you. So I think that is the preamble. Of course, within that, there will be pockets of vulnerability. You will suddenly find one asset class popping up as a massive outperformer, another one being a significant underdog. So I'm saying you will find those kind of moments. But I think finally what matters is that what is the big picture. And today there are clearly I would say global headwinds, which is kind of pulling down even the Indian economy. Not entirely. We're still kind of the Shahenshah types as far as the markets are concerned. But there are many Pathans in the market. So, that's where we need to be a little bit careful how the oscillation will happen. What is happening, if there is a recession, are we behaving very utopian? Answer is probably not. But there will be those, as I said, moments of sectoral rotations, and which is happening way more rampant. For example, there will be interest rate gyrations. You will see central bankers probably plateauing out this year, but will it be time for them to pivot entirely? So there are too many sum of moving parts. So I think keeping your head very high above your shoulder, point number one. And second, as I said, look at it what your risk-return marriage is. I think the marriage of risk and return is exceedingly important as you plan your asset allocation journey.
So, let me take that one by one, right? I mean, you said India is a Shahenshah, but there are many Pathans. And one of those Pathans is China, perhaps. There is the valuation argument. I mean, if you look at all the countries, and China is, I guess, undervalued. India may not have too much valuation headroom left. In that sense, do you see a lot of money perhaps moving out of India and into China? Because that's a common narrative that people are speaking about, just purely based on the valuation headroom.
No, definitely. If you see, everything looks good at a price. So by virtue of that, anyways, if you see global asset allocators, they've been allocating money across geographies. And within EM, clearly, China is showing you that small, I don't know, green shoot, sweet spot, the way you like it, the way you want to call it. It's been a bulbulaya. There is no two ways about it. But some bit of the mystery is unraveling. And we are seeing global asset allocators, I won't say pouring money into China, but clearly trying to pair a little bit of position from India where they were visibly overweight and going, some allocations in favor of China. Whether it's a momentum play, whether it's more of a dead cat bounce, etc., time will tell. But some bit of allocation we're already seeing as we speak underway. Some bit of it also happened in 2022. Which is why we saw FPIs turn net negative, both equities and fixed income, to a larger extent on equities. Well, the month has just started and too soon to call it a game, but I think even so, month so far, month to date, we still net sales negative as far as the foreigners are concerned.
Absolutely. So, that brings us to the next question, right? What should the appropriate asset allocation strategy be for 2023? I ask you because we are seeing these outsized gains in gold. Gold is at a record high as we speak. And if you map the last 7 recessions, you will see that gold has outperformed the Sensex in most of them. Right. So what should the asset allocation strategy be? How much in traditional assets like equities? How much in alternative assets? What's your best guess?
So on the gold part, well, we have been pretty, vociferous about having allocations to gold as part of asset allocation for a fairly long time. Well, that didn't change at $1,750. It doesn't change at $1,930 because it's not price movement. It's about having that tail end allocation to an asset like gold in a market like this, which is the, volatile, uncertain environment. So that's the tail end part of it. Even at the risk of gold rallying maybe another $50, $100, $200 from here, I would say keep that as a tail-end allocation as part of your overall financial portfolio. Then that moves you to the financial portfolio that you can keep toggling between equities and fixed income largely. Again, basis what are your immediate milestones. So if I would say that, if you have a very, very immediate goal, say next couple of years, the portfolio has to be visibly overweighted fixed income contrary to equities.
Oh.
But if you say, what, I don't need this money for the next 10, 15 years, why are you even, trying to do this asset allocation? For that investor, I would say have an overweight of equities. Of course, there we can try to get the market capitalization, etc., right? But then have a subservient portion of fixed income. And then some bit of, alternates like REITs, InvITs. These are all, the tendency of doing a fixed income plus. That's the kind of skew or the mix you need to have. But these are largely financial assets. So have tail-end allocation to gold. About 10% is fair. You can do 5, you can do 7. There's no science to arrive at that number. But be around 10%. Don't be too greedy and don't chase returns. I think
so
that's
I want to take that greed point forward, right? Because generally when you see assets zooming like that, I mean, gold, I think, was, as per the MCX price, in the month of October, it was 51,000. Today, we're sitting at 58,000 plus. So that's when you feel that FOMO feeling. Do you think it's too late to get into assets like gold?
It's not at all late. I'll tell you why, Sonia, because today you see global central bankers are buying gold. That's number one. Number two is when risk asset classes tend to get a little bit into the frothy zone, sometimes in pockets, that is when gold starts, stands as a tall person in your portfolio. So I would say when you are planning an asset allocation, it's a journey. And in that journey, it is never too late. So you say that, okay, I missed one junction, so I could not do a pit stop for a chai break or a water break. It doesn't matter. You have another junction, which could be probably 2 miles away or 10 miles away, but that finally the junction will come. And definitely, gold should be some part of your portfolio, irrespective of the price point.
And you can never really catch levels, right? I mean, you don't know. Gold has already rallied about 10% from the lows. Maybe there's another 20-30% to go, given the situation. Got that? So we're talking alternate assets, right? Should you allocate more money to alternate assets, not just gold, but fixed income, REITs, there are InvITs, in a volatile market like this? If yes, then suppose you have, say, 100 rupees. In this market, in 2023, what should the split look like?
Within fixed income or across assets? Or
Across assets and then within fixed income as well.
So yeah, two parts to it. REITs, InvITs could be extended arms of fixed income allocation. They are hybrid instruments, so they are dividend paying, as well as there could be some upside depending on how the macro plays out and the underlying plays out. So yes, REITs, InvIT do make a classic case to be part of your extended fixed income portfolio. In today's dynamics, if you are a tactical asset allocator, which is, you're looking at next 4 to 6 quarters, looking at the risk reward, valuations, all of that which go into your asset allocation over and above your goal setting, there is a case to be skewed towards, a fixed income, kind of a portfolio if you are looking at the next 3 to 4 quarters. And within that fixed income piece, I would say the bucket in the band of 3 to 4 year duration, that makes a lot of sense. Okay. And why I say that makes sense, because the yield curve today is absolutely flat, which means what's yielding you here at the mid end is not significantly lower than what's yielding you far end. So on a risk reward basis, why populate your portfolio with additional risk? So I think that's where it does make sense. But as I said, the caveat here is if you are looking at for the next 3 to 4 quarters, that's when you might want to do a little bit of rejig. But otherwise, if these things don't deter you, the reds don't bother you, and the greens don't excite you too much, then you're pretty sorted where you are.
Okay, well, on that note, let's take a short break, but don't go anywhere. We'll be back with our Outstanding Women in Finance series in just a bit. We'll speak more about asset allocation in this year. Stay tuned. Welcome back. Thanks for staying with us on Smart Money as part of our Outstanding Women in Finance series. I have with me Lakshmi Iyer, who's the CEO Investment Advisory at Kotak Investment Advisors, and she's telling us how to approach the markets in 2023 given all the volatility that we're seeing right now. Lakshmi, thanks for staying with us. Before the break, you were telling us about how perhaps you should be a little cautious on equities and look at other asset classes. You said you should have an exposure to gold, of course a smaller exposure, but exposure nevertheless. What about REITs and InvITs? That's a fairly new asset class. Tell us a little bit about, if I'm a layman and I'm a rookie in REITs investments, how should I go about it?
So Sonia, if you want to own real estate but want the liquidity attached to it, then REITs are the best way of ownership, and of course that includes InvITs, which is infrastructure assets. It's pretty seamless as the way you transact in any stock. It's available as a listed entity on the stock exchange, so you just go ahead and buy and sell. The only caveat you need to keep in mind is relative to stocks, or maybe the larger stocks which are traded, the liquidity might not be that very high. So there could be an impact of entry exit. So have a sparing proportion of that to your portfolio and don't make it an overwhelming portion of your portfolio.
But don't you think it's better to have exposure to real estate stocks instead?
Stocks are very different. Stocks are part of your equity exposure. REITs and InvITs, I call them the hybrid instruments. So they have the risk-reward trade-off. They allow you a participation in the growth story and therefore some equity upside. But they are constant, dividend-paying kind of instruments, and therefore more aligned to the fortunes of fixed income. So it won't be strictly comparable. And inherently, real estate is high beta, high volatility. REITs, InvITs are not. So I think that's where the differential is. So I would call REITs and InvITs as an extended arm of your fixed income allocation and not equities.
Okay, got that. Since equities is our first love, right? Let's get back to that. How cautious are you on equities now? I ask because throughout 2022, despite so many challenges thrown at the markets, the Indian market was quite resilient, one of the best performers. You still exhibit some caution this year?
I would say it will be in patches. We are cautious given price. Bhav Bhagwan hai is what we all live and swear by, and that is a reality. So when you compare it to some of the global peers, obviously there is some concern in terms of long-term averages. The way you look at it, obviously the valuations are not cheap, may not be astronomically high, so somewhere the truth lies in between. So it's okay to be a little bit more guarded when you are allocating money to equities. Not allocating is not a solution because you don't know how much, how far, how soon it will correct. But I think given where we are and given the global dependencies, given the kind of headwinds that some sectors are facing, even in India, given global uncertainties, it's okay to have a slightly more guarded approach when you're deploying money in equities.
So when you say guarded approach, suppose I want to reduce my exposure to equities, right? Given it's a recession coming up, should I move to raise my cash levels? Should I sort of churn out into debt? What's the right approach now?
So if you are ab initio 70-30 and you are say 72 in equities and the remainder has come down, then plow that 2 rupees out into the asset class which is supposed to be. So that is one way to plan your asset allocation. The other way is if you're in the deployment stage, then go easy. Do it in installments, go in a staggered manner, have 100 rupees in a debt fund, in a liquid or an ultra short-term fund, and stagger it into 6 or 7 installments so that you're able to ride through this wave, because it's humanly impossible. At least I don't know how to get it right, how to get you the best low point and get you the best exit point. That's difficult.
Okay. So what are the big risks to this market now? Of course, there's a global recession, there's valuation concerns as well. But what else would you put on the key risks list?
So these were the 2 key risks that you very well articulated. Aside of that, I would say the geopolitical risk. I don't know when you're sleeping which country is out to attack another country. So that's a risk which you cannot ignore. The other key thing is inflation in some pockets. Whether it's the globe or whether it's India, the core inflation is still very sticky. So how long will you have high interest rates? So plateauing out doesn't mean pivot. Pivot means you actually head towards rate cuts, which does not seem to be the case yet. So I think these are some of the other risk factors over and above the fact that valuations are there, global uncertainties persist, and of course, closer home in India, we are in the earnings season. So how many beauties come, how many ugly ducklings, and all of that. I think it's going to be a mixed bag, and it's going to be a treadmill. So you have to brace yourself and keep your energies high.
Okay, we just have a couple of minutes left. So Lakshmi, you've been with Kotak for over 22 years now, and this is a day and age where people are changing jobs like they change their clothes, right? I was reading a review which suggested that out of 4 people, 3 people are looking to change their job in 2023. What is your advice? What is your guidance to young investors, fund managers, perhaps who want to follow your footsteps, who are watching you right now?
Sonia, I got married to Kotak before I got married to my spouse. So marriage is a long-term commitment. So you have to stay committed unless there is something which changes very dramatically. That's number 1. Number 2 is when you get up and say TGIM, thank God it's Monday, equally in the same zest as you say TGIF, I think that's what sustains you. And I think that's exactly what has led me to continue in this organization, in this firm for 23 long years, because you are an employee, yet you feel empowered like an entrepreneur. So I think that's very important for all aspiring youngsters, all of them. This is the world of instant gratification. You post a picture on Instagram and you want to see likes. Life is not like that. Career is not like that. So be patient, be persuasive, and go for the long haul. It's fully worth it.
So one final question, right? Because this is a question that always crops up on my mind across industries. We are seeing so much disruption. There are reports suggesting that in 5 years from now, all our jobs are going to be taken by AI or by machine learning, by a bot, so to speak. How do you stay relevant at a time like this?
See, upskilling, there is no 2 ways about it. You have to stay relevant. You have to be abreast of what is happening, quite literally. So you have to walk the talk. If you believe it is good for the industry, it has to be good for you in person. So upskill yourself, take courses, attend workshops, do all of that, read a lot, and keep yourself relevant. I think it's so very important. I don't think doing away with human beings could be an option, at least till the time I retire for sure. But
hope not.
The point is, but the point is, using technology as your friend and not looking at it as a foe is going to be extremely important.
Okay, I guess the buzzword of 2023 is going to be upskill, right? That's the only way to stay relevant and stay dynamic. Got that. Lakshmi, it was a pleasure speaking to you. Thank you so much. I think we generally talk markets a lot, but today we had the softer, finer side of things that we spoke about with respect to your career. And since it is our Outstanding Women in Finance series, I want to wish you all the very best. I hope you have another 22 long years of your career and wish you all the success.
Thank you so much.
Okay, with that, it is a wrap on this edition of Smart Money. Thanks a lot for watching. Keep writing to us and letting us know who you want us to feature on our shows. And we love receiving your feedback. Have a great weekend. Keep watching CNBC TV 18.